Sometimes the biggest problems start with a quiet little tremor that nobody notices. Well, right now, a crisis is brewing in this massive, kind of little understood corner of finance. We're talking about a $1.8 trillion market that promised investors the world and is now slamming its doors shut. Let's get into it.
So just imagine for a second. You get a message from BlackRock, the world's largest asset manager. You tell them you want your money back, and they say, yeah, you can only have half. This isn't some hypothetical scenario. This actually happened, and it's a massive blinking red flag that something is seriously wrong behind the scenes on Wall Street.
But here's the thing. BlackRock isn't some lone wolf here. Nope. This is just one piece of a much, much larger, and frankly, way more disturbing puzzle that's unfolding across the entire industry.
Think about it. We've got titans of the industry like Blackstone and Blue Owl joining BlackRock. In just the last few weeks, 3 of the absolute biggest names in the business have all put up gates to stop investors from pulling out their cash. This is basically the Wall Street equivalent of a bank run, except it's all happening in the shadows, far away from the bright lights and heavy regulations of traditional banking.
And it's pretty wild to see how each firm handled it. Blue Owl, they basically welded the door shut, permanently canceled withdrawals. They told investors, you'll get your money back when we decide you can. Then you've got Blackstone, who took a super dramatic route. Their top executives personally injected $150 million of their own money to meet the withdrawal requests. A bold move for sure, but maybe not so sustainable, right? And BlackRock? Well, they kind of just left the door ajar, sticking to their 5% quarterly withdrawal limit and telling everyone else to get in line.
So what on earth spooked investors so badly that they all made a mad dash for the exits at the exact same time? To really get what's going on, we have to rewind about 6 months and look at what now look like the first warning signs, or as one famous CEO put it, the first 2 cockroaches.
Okay, so back in September of last year, 2 companies that seemed totally unrelated just imploded. One was a subprime auto lender called Trickle, and the other an auto parts maker named F-Brand. At the time, they just looked like isolated incidents. Turns out, they were the canaries in the coal mine for this entire industry.
And this is where all the hidden risks start to bubble to the surface. Trickle was out there selling bonds with a AAA rating, supposedly as safe as U.S. government debt. The reality? It was just outright fraud. I mean, they were pledging the same single car loan to 3 different banks. Their bonds completely cratered, falling from 100 cents on the dollar to just 12. At the same time, F-Brand was being presented as this healthy company. The truth? Its debt was way, way higher than anyone knew, and it collapsed just weeks after getting a clean bill of health from auditors, leaving behind $1.2 billion in liabilities.
Right after these companies went belly up, JP Morgan's Jamie Dimon says something that now sounds kind of prophetic. He said, when you see one cockroach, there are usually more. See, he wasn't worried about just those 2 companies. He was worried about where their bad loans were hiding. In pension funds, insurance portfolios, and yeah, in the private credit funds sold to regular people like you and me. And that brings us to the world these cockroaches crawled out of. It's this huge, murky ecosystem known as the shadow banking system, and specifically a corner of it called the private credit market. So, what even is private credit? Well, the idea is actually pretty simple. It's a $1.8 trillion market where firms that aren't banks, your Blackstones and BlackRocks of the world, lend money directly to medium-sized companies. These are the businesses that are kind of stuck in the middle, too big for a small business loan, but not quite big enough to sell bonds on the public market. You see, this whole market just exploded after the 2008 financial crisis. New rules came in that made traditional banks a lot safer, but it also made them super risk-averse. They basically stopped lending to a lot of these medium-sized companies, and that created a huge vacuum. Private credit funds, operating with way less regulation, just rushed right in to fill the gap. And for the last 5 years, they've been selling this thing to everyday investors with what seemed like an unbeatable pitch. It was like, hey, give us your money, we'll make these long-term loans that pay you fantastic returns, like 8 to 12% a year, and the best part? We'll give you semi-liquidity. You can take out up to 5% of your money every single quarter. I mean, it sounded absolutely perfect. But that perfect promise, it had a fatal flaw, a huge one. The whole model assumes that not too many people will ask for their money back at once. They're taking your short-term, accessible cash and locking it up in these long 5 to 10-year loans. So here's the billion-dollar question. What happens when the music stops and everybody tries to run for the door at the same time?
Well, we're seeing the answer to that question play out right now. The cockroaches? They spooked investors, yeah, but the real reason for the panic is at the very foundation of the private credit industry. All those companies they loan trillions to is starting to crack.
So where did all this money actually go? A staggering 25% of the entire private credit market is loaned out to software and tech companies. Why? Well, for years, subscription-based software, what we call SaaS, was considered the perfect, safest business model you could find. It had predictable revenue, sky-high profit margins, and customers who almost never left. And then AI came along and just blew that entire model to bits. Every single thing that made SaaS a safe bet is now under attack. That customer stickiness? Gone. AI can migrate incredibly complex data in a week instead of months. Those high profit margins, they're getting eroded. A single person with a powerful AI tool can now compete with a 300-person development team. And that stable revenue? It's seriously threatened. Why pay $1 million a year for software when a new AI tool can do 80% of the job for a fraction of the price?
This whole disruption is so profound, so fast, that traders on Wall Street have already given it a name. They're calling it the SaaS apocalypse. The very industry that private credit bet a quarter of its entire portfolio on is now in the middle of a full-blown existential crisis, and it's all being driven by an AI revolution that moves in months, not years.
And this is what has investors absolutely terrified. A recent report from Credit Suisse forecasted that in a scenario with accelerated AI disruption, the default rate in private credit could soar from less than 3% today all the way up to 13%. That's more than 3 times the default rate you'd expect from high-yield junk bonds. Investors are seeing this writing on the wall, and they are desperately trying to get their money out before the defaults really kick in.
So all of this, the murky assets, the failing ratings, this sudden liquidity crunch, it all leads to the one big question on everyone's mind. Are we just watching a replay of the 2008 financial crisis? And look, the parallels to 2008 are definitely there. It's kinda eerie. Opaque assets, rating failures, a sudden liquidity crunch, it all sounds familiar. But, and this is a big but, there are also crucial differences that could prevent a full-blown meltdown. And the most important one is just scale. The entire private credit market today, as we've said, is about $1.8 trillion, which, let's be clear, is a huge number. But the U.S. mortgage market back in 2008, that was over $10 trillion. And it was woven into the balance sheet of every major bank on the planet. Private credit, as big as it is, just isn't at that systemic level yet. Plus, these funds have those structural gates, like the 5% limit, which are designed specifically to stop a full-on bank run. And you can bet regulators are paying much closer attention this time around.
So as this whole story unfolds, here are 3 key signals for you to watch. First, the redemption data for the second quarter. Does the run on these funds get worse or does it calm down? Second, fundraising. Does new money keep pouring into this industry or does the well finally run dry? And third, and this is the most important one, the SaaS loan default rate. Does it start creeping up toward that terrifying 13% forecast?
You know, back in 2008, the bomb went off inside the banking system. This time, the bomb is ticking next door, in the shadow system. We can definitely see cracks forming in the wall between it and the real economy. The only question now is just how thick is that wall?